a data nerd, a numbers nerd, but I really enjoy working with our clients in terms of evaluating their performance and seeing what's going on in the industry. So I'm excited for today's webinar, and I hope it's very valuable for you guys as a whole. And like Kurt said, if you have any questions, feel free to submit them to the portal, and we'll discuss them at the end there. You can also submit some questions offline to me by email, and I'm happy to answer them through email or possibly set up a call to discuss some of those things. Okay, so here we go. Before we kind of get into some of the numbers, I wanted to talk a little bit about Richey May Select. For those of you who don't know it, it's our quarterly benchmarking program, and it's really where the data comes from for today's presentation. That program currently includes over 50 independent mortgage lenders, and we're always looking to add more lenders to that group. The results are used only for aggregated analysis by the participating companies and by Richey May. It's very easy to participate in that program, and because of some efficiencies that we are able to create on the MBFRF and NMLS reporting, we are often able to give time back to participating lenders' accounting departments. So I plug this just because it really is an affordable value add. It helps us bring extra value to our clients through audit and tax engagements that most CPA firms aren't able to offer. So if you have any interest in this, please reach out to me. We can set up a call or demo to discuss it further. And that's it. But anyways, that's it for my shameless plug. You won't hear anything more on that front today. All right, so before we look specifically at 2015, I want to talk a little bit on some broader industry trends that we've seen over the last couple of years. We're going to go over to about what's going on in the cost to originate, retaining MSRs, and my outlook for our clients and the independents in the industry. So there's really many ways we hear others define how or what's going into the cost to originate or produce. For our purposes, we include all expense items that are tied to the origination and sale of mortgage loans in the secondary market. For independent mortgage lenders, that basically includes all personnel expense, except for MSR servicing personnel. And then really most of your operating expenses like occupancy, equipment, depreciation, professional fees, marketing and advertising, technology, and G&A expense. Don't include interest expense or bank fees, loan loss repurchase, indemnification provisions, or other losses that aren't related to mortgage lending or aren't core to mortgage lending businesses. So there is a significant fixed expense component to our cost to originate, and thus there tends to be an inverse relationship between the production volume and CTOs, or what we call cost to originate. So by looking at the graph, you can see this relationship fairly strongly from the first peak in volume during Q2 of 2013 to the low point in the graph during Q1 of 2014. As we move further right on the graph, we can see that the correlation between this inverse relationship has weakened, and that's really one indication that it is becoming more costly to originate. Also, if we put a trend line on this graph, we see that volume has increased 11% over this time period. Cost to originate have increased over 4%, or approximately $494 per loan. And here are the yearly totals, which also clearly shows cost to originate are on the rise. And I don't think that's a surprise to anyone. I think that is a well-established trend, but we'll talk a little bit more about that. But before I go into that, on a side note, I just wanted to mention, whenever I'm doing a peer-to-peer analysis, I prefer to look at the P&L in dollars per loan, especially if we're examining the expense half of the P&L. I know that basis points seems to be typically the preferred measurement, but really in a peer-to-peer analysis, the basis point numbers can look a little skewed if the peers have different average loan sizes. When you look at it in dollars per loan, it tends to even out a bit, and much of the expense items are really closer tied to units anyways. And so, just based on that, that's why I typically lean a little bit closer to looking at it in a dollars per loan perspective, and we'll lean that way a little bit on the presentation. Okay, so what components of the cost to originate are driving the increases? Well, if we look at it, we can isolate all $494 per loan to be driven by increases in personnel expense. In total, operating expenses per loan have been relatively flat, where the budget has shifted around a bit for operating expenses. We're seeing more spent on technology and advertising and less spent on G&A. The shift has shown up a little bit more pronounced as of the second half of 2015, which, I imagine a large portion of that shift is related to TRID, and then I think the data, along with a little bit of hearsay, also suggests that the independents in the industry are looking to invest in technology that will allow them to bring some efficiencies to their fulfillment and back office operations. So with that said, let's kind of look at some of the personnel components that have driven these increases. So first, LO comp. It's accounted for 52%, which is quite a bit of it. I think maybe more than some of us have thought of it, or some other cost to originate analyses. But 52%, it amounts to $258 per loan. And there really are a couple things at play that has led to these increases. During 2014, as lenders saw their production volume dry up, we saw an uptick in LO comp of about 7 basis points. This just being a bidding war for loan officers, as the industry really appeared to be desperate for volume during that time. That uptick of 7 basis points, didn't come back down. It's remained the same throughout 2015. So, one thought I have on this, and something to think about, is, what's the industry going to do with LO comp when production dries up again? Is the same thing that happened in 2014 going to be repeated again and again and push LO comp higher and higher? Or is there, for lack of a better word, going to be a correction in this? So, something the industry is going to have to figure out, something that lenders are going to have to figure out. Obviously, it's a little bit easier to tell your LOs that you're going to get paid more instead of less, but something that I have my mind on. So in addition to, that uptick in LO comp plans in 2014, there was also another increase in this from 2014 to 2015. That was driven by home values that increased and, drove up average loan sizes, which resulted in another increase in LO comp on a per loan basis. Basis points, they were relatively flat, and certainly, this type of increase hurts a little bit less just because you're getting there, you're making up the difference on the revenue side. So fulfillment and back office. So fulfillment, as we define it, includes processing, underwriting, and closing, made up 9%, and back offices, which, as we define it, include post-closing, QC, secondary, and fulfillment and sales support, made up 23%. Both of these functions accounted for 32% in total, and really the major increase or major reason for the increase is that underwriting, processing, and QC, just can't produce as many files as they used to due to intensified guidelines and complexities. Our data also suggests that these departments have been in greater demand for skilled personnel over the last couple of years, which has driven up wages by an average of 15% since 2013. And so the last piece of the pie, corporate comp and benefits. So one thing we're noticing is that the average company paid benefit expense per employee has gone up $1,600 since 2013. Again, that's per employee. And this is kind of both due to an increased cost of offering benefits, as well as companies trying to use benefit packages as a means to attract and retain industry talent. In addition to that, executive compensation has also gone up, and since executive comp is often closely tied to production volume, it's likely that a large portion of this increase is made up of discretionary bonuses during 2015. But there is some good news, and that news is that per loan revenues have trended in the same direction as CTOs. In fact, after some compression from 2013 to 2014, per loan net revenue has rebounded and surpassed the 2013 margin, which was $828 to an average of $1,275 in 2012 or 2015. Sources of revenue has also shifted. In 2013, origination fees made up 7% of origination revenues compared to just 3% in 2015. From my perspective, it's a little unclear if this is like a real shift in the way lenders are pricing loans to borrowers, or if the increase in home values in the refinance waves have caused kind of a short-term pricing strategy of pricing loans more heavily on the back end. We are seeing more lenders get into the retained servicing business. Some lenders are seeing it, as a natural hedge to production, and that's one reason they're getting into it. Some, it's a way to enhance their company's brand and get their branding in front of their customers on a regular basis. Hopefully capturing some recurring refinance and repurchase business. But one of the reasons we are hearing more of as of recent is that it makes lenders more attractive in M&A deals and equity deals. And so that has been a driver for some to get into it or to at least explore it more seriously. Okay, for those lenders who are servicing, they are retaining it at very differing rates. There's very different strategies that people are taking. This chart shows the percent of originated volume that was retained during that period. Certainly, there are some cyclical trends in the retention rate, and this is mostly driven by cash flow needs and profitability. And year over year, it appears that the retention rates are decreasing on average. But I don't know that that is necessarily the case. There's probably a couple things at play, but one of them is going to be, that the group of lenders who are getting into it as a play for M&A or equity deals, they really have less of an appetite to build up a portfolio. And so that may be some of the difference there. And then, it's not as attractive as it was in 2012 and 2013 to retain servicing. Back then, you were practically giving up little to no SRP, and you sold the loan to Fannie and then kept the MSR. But now that value of the MSR and the SRP offered by many aggregators is tightening up, it requires a bit of a more strategic analysis when determining if and how much to retain. So this chart is showing the median volume in blue bars, the average volume in green bars, and the average portfolio value in red. As you can see there, like we mentioned earlier, there's some disparity in portfolio sizes. Partly this is because a third of the lenders have just recently started to retain, and some of the lenders' MSR strategy is to build the portfolio up and then sell it off regularly. It is a little bit interesting to note that, at least in the last 2 years, the portfolio values have seen pretty minimal volatility. We're seeing like a range of 5 basis points, which is pretty good. Of course, that is the average. Some lenders are going to see different volatility in that, depending on what types of products they have, how well their portfolio is performing. But on average, we're seeing little volatility. Okay, so just in terms of kind of my outlook from my perspective, when I see what our clients are doing, I'm very optimistic about the opportunities, for independents to continue to be major players in the industry. Yes, the CFPB has made doing business more difficult. They've made it more risky, but the heightened compliance has added additional barriers for other new entrants into the industry. It's also influenced, some of the major bank players to pull back their business, which, at the same time, has allowed independents to scale their business, minimize the impact of increased regulatory and compliance costs to the bottom line. So that's a highlight. I think that that might be the biggest highlight of 2015 from my perspective, is just that ability to handle some of those added compliance costs because they are able to capture share and scale business. And so the graphs here, they really highlight how lenders have scaled their business. Each individual graph is showing the production volume for the same quarter over the last 4 years. So the top left is going to be, the first quarter of 2015, the first quarter of 2014, first quarter of 2013, and first quarter of 2012. As you can see in 2015, the production levels for each quarter has been the high point, with the exception of the fourth quarter. On top of that, independents have also trended more favorable than the industry as a whole. And this is the red line here is the industry trend during these periods. So, on the CPA, basically CPAs were wired to be a little bit pessimistic. We might prefer the term risk averse. But I have to say, even so with that, when I look at this, I think the prospects of gaining market share have been and still seem to be very ripe for independents. And so, I'm very optimistic about, what independents can do, because I'm seeing that they are being successful in acquiring share. Okay, so that does it for kind of my my overall industry trend analysis and kind of my thoughts on it. Certainly if you have some questions on those, feel free to submit them now. We're going to get to them at the end of the webinar. But we're going to shift gears and focus in on 2015. Here's a snapshot at what 2015 looked like. Average pre-tax income of 54 basis points, or 1278 per loan. However, there was a handful of lenders who were well over 100 bips, or $2,000 per loan. There were also some who were near break even. As is usual, the retail channels were most profitable, followed by direct-to-consumer and then wholesale mixed channels. Returns on equity or returns on net worth were also very high. Now, interestingly, the direct-to-consumer group posted a return of equity of half the retail group. And their bottom line was very comparable. But this really is more of a function of differing equity levels than earnings. Direct lenders in general, not all the time, but in general, tend to keep higher equity levels just because there's greater volatility in that business model. You kind of have to ride the refinance wave and kind of go with it that way. And that's kind of how it's been up to this point. I know that a lot of lenders are expecting the direct-to-consumer model to be the model going forward, as commerce seems to be done online more and more. But I'm yet to hear of somebody who's actually done that and captured mostly purchase business. So something that I know a lot of people are trying to do. Anyways, just with some of the return on equity levels, many owners who have been curiously pursuing or considered selling over the last year or so were kind of reinvigorated with confidence in their own company's ability to generate meaningful returns. And so this has caused a little bit of a pause in some M&A action as of recent. I just want to give a couple seconds just for people to look over this chart, and we're gonna change here in a second. Okay, so here we're just going to look at the year-over-year trend of those same numbers and see how did 2015 compare to 2014. Well, much better, but I don't think that's any surprise to any of you. Pre-tax earnings improved on average 28 basis points, or $750 per loan. Direct-to-consumer saw the largest increase from a negative 10 bips in 2014. And then return on equity doubled for the overall average. Nearly double, I guess. So then let's look at production volume. This is the real story of why 2015 was so good. Major increases in volume, in total an average increase of 44%, and servicing portfolios increased an average of 38%. So let's talk a little bit more about production volume. As we mentioned earlier, production levels were historic for many independents in 2015. And I want to, kind of compare production from the Richey May Select program participants to a couple of broader industry benchmarks. For the entire industry, we're going to look at the MBA's mortgage finance forecast, which is something they put together monthly, and it's available on their website. And then we're going to look at some data the NMLS registry puts out each quarter. NMLS collects company-level data for all non-federally registered mortgage companies, which is basically the independent, non-bank affiliated mortgage lenders. They put out some production volume and product, by purpose, by state each quarter. So those are the two things we're going to compare it to. And anyways, the industry, based on the MBA's finance forecast reports, showed an increase year over year of 29%, and the independents as a whole from the NMLS data has shown a year over year increase of 39%. So really, the whole industry had at least had a much improved year since 2014. But the average Richey May Select program participants beat both groups by 15% and by 5%, respectively. All right, so overall, the program participants saw increases in refinance volume of 85%. Broken out by channel, retail saw a 90% increase, wholesale mix a 93% increase, and direct consumer a 68% increase. On average, the program participants outperformed the entire industry by 36% and the independents by 24%. And so, banks typically own the refi market, and to me, this really indicates that independents have been able to pick up share here. When the 2015 Honda data comes out, we'll be able to see that a little bit more clearly and see by how much, but that's not going to be out until September. Okay, purchase volume. So, overall, the program participants saw increases in purchase volume of 27%. Retail increased by 29%, wholesale mix by 24%, and direct-to-consumer by 52%. On average, the program participants outperformed the entire industry by 11% and the independents by 7%. So again, really, either purpose, we're seeing that the lenders participating in our benchmarking tool, they are outperforming, they are capturing market share, they are scaling their business. Okay, so here we're just looking at some P&L detail. This one is in basis points. I'm not going to discuss, these items in great detail, just because we spoke on them a little bit earlier. But I wanted to make sure that everyone could take a look at these. We'll show it in basis points and dollars per loan. For basis points, all we do is take each line item and divide it by production volume based on close volume. And for per loan, dollars per loan, we just divide each item by the counted loans based on closed loans for each period. I'm just going to stop here, I don't know, for 20 seconds just so you guys can take a look at each of these slides. This one is the basis points, obviously. Okay, and then here's dollars per loan. All right, now I want to just, we'll take a quick look at gross loan margins, I'm sorry, not gross loan margins. We're going to look at this P&L detail year-over-year trend. So here is the year-over-year trend in basis points. And the year-over-year in dollars per loan. Okay, I saw a question about just asking how we calculate these, and I'll just go over it one more time just so people have it. It's pretty relevant. So when we're looking at basis points, it's a pretty simple calculation. We're just looking at each of the line items on the P&L, and we're dividing that number by the total volume. So that's giving us, kind of the average basis points that our performance was. For dollars per loan, a very similar calculation. We're just using the number of loans closed during each quarter or each period as the denominator instead of volume. Okay, so I want to take a quick look at gross loan margins. In total, there was an increase of 13.8 bips, but there was some differences for each channel. Most notably, the direct-to-consumer channel saw the largest increase of 24 bips or $709 per loan. That's something that we've been able to observe over the last couple of years. It's one of the characteristics of a successful direct-to-consumer channel. As I said, at least for the last couple of years, has been the ability to really ride and time the waves in refinance volume. What I mean by this is really, setting your secondary pricing strategy to borrowers, at least in part based on the demand in the market. Just based on our data, most lenders in the program are doing this to at least some extent. Some more than others, obviously. And please don't hear me wrong. I understand there's a lot of factors that go into secondary pricing. I'm not an expert in secondary markets, and this isn't a webinar on secondary. But nonetheless, our data does suggest that that there is something to it. Just when we look at it, the wholesale and the direct-to-consumer channels, they both saw major increases in production volume. When we look at refi volume in particular, the wholesale channel, they had a much larger pickup than the direct-to-consumer, but the bottom line was not really comparable. The direct-to-consumer channel clearly outperformed the wholesale channel, and in part that's a little bit driven by the direct-to-consumer's ability to up their loan margins with the demand for refinance volume. And so I know that wholesale lenders should not necessarily treat their margins the same way. Their model doesn't lend itself to the exact same kind of flexibility that a direct-to-consumer lender might have or might be able to in terms of this. But they're both channels that are have a heavy refi mix. Something to think about, because this certainly is a separator in the bottom line. There's other reasons to adjust gross loan margins to market demand as well. One of those is going to be capacity. Lenders have a ceiling of production that they can take in. Typically this isn't the normal problem. Usually it's that they're, it's the other way where we're trying to bring in volume, but that ceiling that lenders have it's really dependent upon available resources from fulfillment and back office personnel. There's also warehouse limits and cash limitations, among others. And during that first half of 2015, we did have conversations with some lenders who were scrambling to add to their warehouse credit limits because they just had too much production pouring in, and they were struggling to fund the loans in their pipeline during that first half of 2015, which really that's a bad problem. If you have to turn away business because of capacity, it's bad in the marketplace. It's bad for your LOs, and so I don't know if we're going to run into this issue in the near future, but something to think about and something to consider. So that is it for the benchmarking presentation today. That's the material I wanted to cover. So now, if you guys have questions, feel free to submit those in the question inbox by submitting it through a webinar, and we'll get a couple of these answered. I just want to give a couple minutes for people to put those questions together. All right, so here's one question asking about retaining MSRs. Are they servicing in-house or outsourcing it to a sub-servicer? So I don't have an exact number on it, but probably 80 to 90% of the lenders who are servicing are using a subservicer, there certainly is kind of a volume that you really need to be at with your servicing portfolio before you even bring that in-house. And that volume, don't quote me on it, but it's probably somewhere above $1 billion volume. Okay, somebody had a question about what goes into gain on sale. So when we talked about a couple things in the presentation, we talked about gross loan margin, which when we say gross loan margin, it's basically all secondary revenue. It's going to be, so that's going to include, gain on sale, release, retain. It's going to include the capitalized MSR. It's going to include SRP. It'll include, pair-off gain loss. We have some direct costs, which would be mostly investor fees. Some miscellaneous underwriting fees or some leakage. And we also do origination fees, which is going to be the origination charge. Will be any pass-through expenses, and it will be discount points or premium points. That together is all going into our gross loan margin. We are going to make the slides available on our website at the end of the presentation. Here, I get a couple more. Okay, this is a great question. Somebody asked, how do they enroll in the quarterly benchmarking program and what's the cost? So our quarterly benchmarking program, what we do is we collect your trial balance and we collect some other payroll headcount information and some information from your LOS. Pretty simple. You submit that stuff to us. We go through a mapping process and get that mapped to the standard format. So there's a little bit of time involved or invested in that piece of it. But really the best way, if you're interested in moving forward, is let's just have a call, let's talk about that, and then we can get started. The cost, the annual subscription of $3,000, and that gives you access to the database, software-based tool that it's housed in. And there's a one-time implementation fee of $2,000, and that just covers that front end of getting your data into the format and backfilling some historical data so you have some of that reference. Now, when somebody asked about production mix, and I didn't quite get into production mix, but really, with the exception of a few lenders who would be very niche focused, I really find that most independents have a very similar mix. It's somewhere between 35 to 55 of is government, and then the rest is usually conventional. Some lenders are into jumbo, but typically it's that 35 to 55% of government product, which we see most of our independents having, and that's probably the biggest difference between independents and the rest of the lenders. Somebody asked a question about how many current participants. We have over 50 lenders participating in our program right now. Looking for more. Okay, I think that looks like it's it. I'll just assume that any other questions will be sent to me by email, and we'll go from it there. So thanks for your time today. I hope it was valuable and you guys got something from it, and I think Kurt has a couple items.
Yeah, well, I just want to thank you for attending our webinar today, and a special thanks to Tyler for taking the time to put together the presentation and present today. It looks like we did get through all the questions, so if you do have a follow-up question, feel free to submit it over to us and we can reach back out to you. As always, we're trying to provide topics on our quarterly webinars that are both timely and informative in today's environment, and so we welcome your ideas for any future webinars that you may have. If you do have a suggestion, please email us at info@richeymay.com, and we'll look at those and take them into consideration for sure. And then finally, just a quick reminder, I know we said it a couple times, but we will be posting this webinar to our website, and also all the registrants will also email out a copy of the slide deck. So Looks like we finished just a little bit early, but I want to thank everybody for your time, and hope to see you on our next quarterly webinar.